Sam, Richmond Brown, we've seen volatility steady this spring with the VIX, or the so-called fear index, below 15 most of the time after seeing it pop above 20 in January and February. So what's your outlook for volatility for the rest of the year?
Right, I think that's a very interesting question. I mean, obviously equity volatility has to some extent remained contained, but if you look at interest rate volatility or currency volatility, there's been some quite substantial pickups. So interesting to see that there's been no spillover for the time being. We believe that the reason for sort of a very mutated volatility environment is essentially due to the influx of liquidity. There's still a lot of stimulus in the system. Going forward, as some of that is retracted from the US, and as things do diverge, both from a monetary policy standpoint and also a growth standpoint, we would expect, logically, the VIX to increase back to its historical levels, because it's obviously well below that currently.
So with this in mind, how should investors protect themselves?
I think it's a very broad question. First and foremost is to remain open-minded, remain nimble, remain flexible, resort to a very broad investment universe. Do not put all your eggs in one basket. So we're finding opportunities in equities currently, currencies, interest rate risk. We think it's potentially the wrong time to be taking on additional interest rate risk. But there are certainly ways to benefit from the divergence that's occurring across the globe, whether it be in terms of monetary policy and growth. Areas of opportunity, but you need to remain selective and have a very diversified portfolio.
All right, let's talk about where you're selecting in your Seeyond fund. Which sectors within the stock market do you like?
So we're still constructive on equities. We think there's light at the end of the tunnel. US economy and US growth should remain supportive. And we see also opportunities in Europe with a low euro, low oil, low inflation, additional QE, which should play into, obviously, the equity markets in the Eurozone. So we remain constructive on equities. We think that an interesting tool to have within the portfolio is a currency positioning in the dollar. So we've been long dollar for a while, which we believe is a more effective trade than piling on additional interest rate risk.
And clearly one of the big worries about Europe right now is what happens in Greece. How worried are you about Greece?
Greece is an issue. However, there's far more to Greece than Greece. We believe that obviously the Eurozone is more than simply a common currency. 19 member states, which has huge implications. It's a very important area of the globe in terms of world trade, but also foreign direct investment for the US. So there are implications beyond simply Greece, which in our view is a relatively contained situation currently. Obviously during periods of irrational decision-making, that can throw up a lot of noise and volatility. So we're monitoring that closely, but we do expect a resolution.
And traditionally, when interest rates rise here in the US, it hurts emerging markets. What's your emerging markets view?
We're more in the why bother with emerging markets currently camp. So obviously we think there are greater risk than greater opportunities in emerging markets. We also view potential currency weakening, increasing percentage of foreign debt to GDP ratios in these regions as a real risk. So we don't have a constructive view on emerging markets currently.
All right, thanks a lot, Sam.
Thank you for having me.